What's up guys, it's Louis here, hope you are doing great. If you want to know how you can grow your money in the stock market, this video is for you. I'm going to say a few things that is probably going to piss people off, but this is just my opinion and my against the grain type of thinking. I've been investing in the stock market for around a decade now, and I've learned and witnessed quite a few things. I've also spent thousands of rands on courses, books, mentors and seminars to learn as much as I can, and in this video I'm going to share a breakdown of my conclusions. I'll be talking about the differences between shares and CFDs and why this is important. I'll be touching on dividend stocks and why I completely avoid them, and last of all we'll be talking about investing in the famous S&P 500. The S&P 500 is a method of diversifying your portfolio, reducing risk and increasing exposure to the market. But in my opinion, it's just an average investment. On average, the S&P 500 has returned 11% over the past decade. And in my opinion, investing in the S&P 500 is for anyone that doesn't have the time or skill to pick great stocks themselves. And that's totally okay. But let me show you a short clip of Warren Buffett and share what he says about diversifying or investing in a basket of stocks.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses.
Of course, I'm not Warren Buffett, and you're probably not as smart as him either, and that's why he actually recommends investing in the S&P 500 to diversify your portfolio if you don't have the right knowledge to pick individual shares yourself. But did you know that Warren Buffett doesn't invest in the S&P 500 himself? He has the knowledge and the skills to pick great individual shares on his own. If we have a quick look at what the S&P 500 has returned over the last decade, the investment itself is really not that impressive. So let's use an amount of 100,000 Rand. And let's say, for example, your average person or working class individual has 100,000 Rand to put away on one shot. So if we invested 100,000 Rand today, and if we get a return of 11.02%, which is the average return over the last decade, so let's just assume we'll get the same return for the next decade. If we invested 100,000 Rand, after 10 years, our interest portion would be 184,000 Rand, or in total, our portfolio will then be worth 284,000 Rand. And don't get me wrong, this is a great way to grow your money over the longer term with low risk, and there's actually no hard work involved. You don't have to monitor the market on a daily basis. You can simply park your money there and leave it over the longer term. But the point that I'm trying to make is that after 10 years, having 284,000 Rand is not going to make you retire. It's not going to help you reach your goals today if you only receive your money in 10 years. 10 years is not that long based on investment terms, but we want to benefit from our investments in the short term as well. I'm not sure if it's just me, but I don't want to be rich when I'm 60 years old and had my S&P 500 compounded for 40 years. That's just not realistic. And of course, I'll still be using this as an investment vehicle. I just don't think that it's the best way to grow your money in the shorter term. And there's obviously so many people that believe in the S&P 500, and it has yielded great returns overall. But again, is it going to make you rich in the shorter term? Before I forget, the app that I use, or the platform that I now use to invest in these different instruments, is called Brockstock. This is an app that I've made many videos about, and I really just like using the app based on its user friendliness, all the info and news and analysis that the platform gives you. It's just such a great app to get started with, and even if you are an experienced investor. The reason I also recommend this app is because they always have these cool promos when you register and sign up. For example, this month, if you sign up and deposit 5,000 Rand or more, you will get a guaranteed JSE share. So if you want to, sign up with my dedicated link down in the description and get started with Brockstock. Then we are going to talk about dividends. Many investors believe that dividend investing is the best way to grow money, but honestly, I think it's pretty stupid. Unless you are Warren Buffett again, that can buy majority stake in a company and receive massive income from these shares, then it's a different story. So yes, it's of course an easy way to receive passive income while growing capital slightly, but based out of my experience, I think there is better ways to invest. Some of the risks you might face with dividends is dividends actually being taken away. This is a massive concern. People that chase stocks with high dividend yields will eventually fall into this trap. These companies with high payout ratios will stretch themselves financially and eventually reduce their dividend due to lower revenue or bottom line profit. Also, dividend companies overall have little to no growth in the short term, which kind of defeats the point of investing in stocks. Then of course, these dividends get taxed at 20% before they even reach your account, meaning there's no way to reduce your taxes before you receive the income. It's like earning a salary. You already get your tax deducted from your income. Some of the key information you'll need when investing in dividend stocks is knowing dividend per share. This is simply the amount of money paid out for each share you own, and it's usually expressed in cents per share, for example 20 cents per share. You'll also have to understand the number of shares you own. This simply means the ownership of the shares. Then the dividend payment dates. This is simply the dates in which your company will pay out your dividends. Some will be annually or some will only be quarterly. Then you obviously need to know your share price. If you want to calculate the dividend yield or how much the dividend is compared to the share price, you'll need the current or past share price. Then of course, the basic calculation you need to understand is total dividend income equals your dividend per share multiplied by the number of shares you own. For example, company XYZ pays a dividend of 15 cents per share. You own 1,000 shares of company XYZ, which equals 15,000 cents or 150 Rand. The key point is, if you really want to make good money with dividend stocks, you need to reinvest your dividends to compound your growth, which kind of defeats the purpose of dividends because you want to effectively live off your dividends, right? But let's say you buy Sun International, for example, and they have a dividend yield of 9.76% and they pay it out annually. You will have to take your desired annual income, and let's say you want to earn 120,000 Rand annually from this one stock. You'll have to take 120,000 Rand and divide it with 3.51 Rand, which is the last payout of Sun International. That means you'll have to own 34,188 shares to earn 120,000 Rand in a year. In real money, it means at the current share price, you'll need to have 1.2 million Rand invested in Sun International to receive around 120,000 Rand in annual dividend income. I don't know about you, but this doesn't blow me away. Using 1.2 million Rand, there's much better ways to increase your income. Then of course we get to what I prefer investing in, and it's individual shares and CFDs. If you haven't heard of CFDs before, it stands for Contract for Differences. And the key difference between shares and CFDs are that share trading or share ownership is where you actually buy shares in a company and have ownership of the company. And this basically just means that you have the benefits of getting dividends, for example, and you actually have voting rights in the company. But it's still just a piece of paper, or in most cases, a digital certificate. CFDs, on the other hand, like I mentioned, is contracts for differences, and when you buy CFDs, you never actually own the share. Some people just don't like that, and I understand it, but a CFD is a derivative product where a broker typically agrees to pay a trader the difference in the value of a security between an opening and closing price. Traders can open long positions, basically speculating that the price will rise, or they can open short positions speculating that the price will fall. If you ever heard of making money when the market goes down, that is called CFDs. So how much profit or loss a trader potentially makes will depend on how many CFDs they buy and what direction the price actually goes. CFDs include leverage, which means traders can open a larger position with only a fraction of its value. Basically, you borrow the rest from your broker. This is like using debt to buy investments, for example. Of course, there is a lot of risk involved. For example, in order to gain access to a 1,000 Rand position with a 1-to-5 leverage, which is effectively 20% margin, a trader would have to deposit 200 Rand to their broker's account. If you don't understand margin trading, make sure to check out this video before you get started. It's really important to understand margin, leverage, and the risk involved when trying CFDs. On the contrary, traditional share trading involves buying shares of companies for their market value through regulated exchanges and brokers like Easy Equities, for example, and it can potentially require more capital. Using the example, you'll have to use the full 1,000 Rand to buy the share in question, so there's no leverage involved. Share dealing can be used as a more long-term approach with less risk, where the investor expects the price to rise over a time frame of maybe months to years. CFD trading, meanwhile, tends to be considered a shorter-term investment where traders open and close positions within days or weeks or maybe a few months, partially due to overnight fees involved, which is called swap fees. Ultimately, it's down to the individual trader to decide which instrument will best fit their risk profile and trading objective. While CFDs can offer you access to a broader range of market for a low initial outlay, this comes with risk, of course. Share ownership, however, comes with its own set of benefits such as voting rights and potential dividend payouts. In deciding which instrument to include in your portfolio, remember to do your own research. Looking at the latest news, fundamental analysis, technical analysis, and a wide range of commentary, note that prices can and do go down as well as up, and make sure to never invest more money than you can actually afford to lose. I wanted to show you a small example of some of the trades that I made last week using Brockstock with CFDs. I'm going to show you my smallest trade so that I don't set false expectations, but it looks something like this. Using the Brockstock app, my latest trade last week was on Nvidia, where I bought it at around $138.09 and I ended selling it for $139.97. In real terms, it was only about a 1.3% increase, but because I used leverage of 1-to-5, it was actually a 6.8% return after all of my fees, meaning my commission fees. I ended up with a 3.6% daily return. I know that doesn't necessarily sound like a lot, but on average I make around 8 to 12 trades similar to this in a month, which really ends up being a good return. If you want to find out more about trading or investing, feel free to pop me an email at louisreinhardt@gmail.com to book a consultation.